Hello and welcome back to the channel. Here is another small video on inheritance tax, an exercise case again to illustrate how we can really use the rules about which we have spoken up to now. Case number 2 is again a family drama. Mother and son, M and S, have both left Germany 4 years ago. So you might have the idea, well, then it's no longer a matter for Germany, but one doesn't know. We will have to check it. So they moved to a foreign country where an inheritance tax does not exist. They did this in order to make the case simple for us, because then we have no double taxation problem up to now. That foreign country is, by the way, a member state of the European Union. There is indeed the one or other state of the EU, approximately 1 out of 3, who does not levy an inheritance tax, so this assumption is not unrealistic. Now, S, the son, has German citizenship and M, the mother, has not. Happens. So M has not only left Germany, but after her death leaves to S all her property. A bank account at a foreign bank with 103,618 euro. A house in Düsseldorf, Germany, which M owned or bought during her time here in Germany. The market value of that house is 500,000, and the house and we also have a house in the foreign country where M and S lived during the last years. There the market value is 600,000, and that was inhabited by M and S together in the last years, and S is going to stay in that house in the future for an unlimited period of time, probably until S will be 95. But S is at the time of his mother only 20 years old. S does not inherit any right to a pension or regular financial support due to M's death. And now, furthermore, because of a life insurance contract, S gets a once and for all payment of 200,000 euro because M died. Well, the question is now, how do we deal with that, and how do we begin? And then the next question is, how do we go on? Well, probably what you need is again your printout or your file with the tax acts, and then you need a sheet of paper. Probably the best one is a blank one, probably even more than one sheet of paper, because the case might require some more notes than the previous one. Then my recommendation would be stop the video at this point here, make a note of the important data of the case, try to develop an own case solution, or at least would also be a good idea, to write down or to find it step by step and compare it with my own solution. The first thing naturally would be if it is a taxable event. So let's talk about the solution for this case. Okay, the first thing we have to do is to look into the tax acts. And so what we need is first the Inheritance Tax Act, the Erbschaftssteuergesetz, and there we need the taxable events, paragraph 1. And subject to inheritance tax or gift tax are acquisitions on ground of death. So what we have here is a son inherits from his mother several items of property, or all what mother has. So the first thing is an inheritance an acquisition on ground of death? And there is also a life insurance contract And there is the peculiarity that this money, 200,000, does not come from mother. It directly comes from the insurance company. So one has to ask oneself if this is a separate taxable event. Money comes from insurance company to son. Or if it should be added up. Well, common sense says we should add it up because the life insurance payment was caused by mother. And now imagine you could break down the progression very easily if you allowed or if you were willing to see the 200,000 as a donation from the life insurance company to the son, because then mother could make several life insurance contracts with different societies and then or companies, and then everything would have a low rate. It would even be economically wrong to say that the life insurance makes a donation, because the life insurance is obliged under the contract to make the payment, so that is not a payment by which you wanted to enrich somebody else. So the only economical and legally correct way is to see the life insurance payment as a payment which via the life insurance company was caused by mother to son. But we need to confirm that, and so let's look again to the table of contents, and there we go to the overview about what is an acquisition on grounds of death. The acquisition on grounds of death is first everything you get by inheritance. That's clear for nearly everything which happens here. And then we have under number 4, every financial advantage which on the grounds of a contract made by the deceased, yes, here life insurance contract, is at his death acquired directly from a third person. Also, that is an acquisition on grounds of death. Caused by the disease, so seen as coming from the disease. Okay, so that is our first thing which we can note down. We have an acquisition on grounds of death, including the life insurance contract, and so that's fine. So, taxable event. The inheritance is an acquisition on grounds of death. Paragraph 1, number 1, in combination with paragraph 3, number 1 of the Inheritance Tax Act. Also, the life insurance payment counts as such. See paragraph 3, number 4, Inheritance Tax Act. So that's the first thing. Now we have to have a look at the tax liability. Is it limited or unlimited? That is a question, and we know where we can find the answer. The answer will be in paragraph 2, so let's have a look to paragraph 2. Here in paragraph 2, you see again the tax liability covers the complete property transferred, so worldwide, unlimited tax liability if the deceased at the time of death is an inhabitant of the inland, or the acquirer of the time when the tax arises is an inhabitant of the inland. The tax will arise at the moment of death. We find that out later. So one of them, the word or is the decisive thing. One of the two living in the inland is sufficient to trigger unlimited tax liability. Now, natural persons who have a resident in the inland are inhabitants of the inland. That's not the case, because both have left Germany 4 years ago. So letter A is not fulfilled. German citizens, so German nationals, people having a German passport, who have not yet been more than 5 years constantly abroad, so who have not cancelled their inland residence for more than 5 years ago, Tja, these people still count as inhabitants of the inlet. Now, mother was not a German citizen, so mother is out. For mother, only letter A counts, and letter A was not fulfilled. But the son has German citizenship, and so the son has not yet been more than 5 years abroad, so the son counts as an inhabitant of the inlet. So paragraph 2.1 says this is a case of unlimited tax liability, and as we have now found this out, the next step is naturally to write it down. So this is unlimited tax liability under paragraph 2.1, number 1, letter B, because son S is a German citizen and has not been abroad yet for more than 5 years. See case data, 4 years only. So that is what's applicable here. Now let's go to the arisal of the tax. And you remember that was the case for paragraph 9, probably 9.1. Number 1 of the Inheritance Tax Act. That was the time of death, but we can't be sure. So we will look it up before we go on to number 4 of the tax base. But we can probably do both at the same time. Yeah, so our memory seems to be okay, because paragraph 9.1, okay, sorry, 9.1, number 1. The tax arises in cases of acquisition on grounds of death with the death of the deceased person, but, and then there are exceptions, and if you look over them, if the acquisition is subject to gradation, no. If there is compulsory minimum legacy, no. Not our case, blah blah. Foundation, no. Condition fulfilled, no. Other cases, no, 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 no. So everything what it might be an exception does not fit. So time of death is correct, as we already suspected. So we can proceed to the next step. The taxable amount is the enrichment of the acquirer as far as it is not tax-free. So all tax exemptions must be deducted. And in the case of paragraph 3, so our case, the enrichment is everything which changes owner, minus the liabilities which are inherited too. Okay. That gives us a hint what we need to do, and that means we are directly going to do that. So, paragraph 10.1, sentence 1 and 2 of the German Erbschaftssteuergesetz, the inheritance tax is all the enrichment of the acquirer as far as it is not tax-free. Now, here what is left. The bank account with 103,618. Well, what can we do with that? That's definitively an asset, and now we will have to value that. Well, where could we find that out? Let's have a look to the Tax Act again. It is, as you see, paragraph 11, which states again, decisive is the value of the date when the tax arises, so the value of the bank account at the moment of death of M. Well, that poses no particular problems. Evidently, what was given in the case was the amount of money on the bank account at the moment, which was decisive. That can be assumed. Now, let's be a bit formalistic. How do you value the money in a bank account? How do you determine the value? And the answer is, well, the valuation is made as far as nothing else is explicitly stated or indirectly stated somewhere in the other paragraphs of paragraph 12, then it's made according to the first part of the valuation law, the Bewertungsgesetz. And so let's jump there. And there was, I believe, paragraph 12 of the valuation law, which proudly tells us capital claims which are not mentioned somewhere else, shares and other things, I believe that was. They will be valued with the nominal value, so no big surprise, 103,618, I believe it was, are to be valued with an amount of 103,618. It would really and actually be surprising if you could justify any other value of money than the amount of money which is in play. That is nice. So we can directly put that down as a new result and then go on. So to be valued with the nominal value of the money or so, however you call it, paragraph 11, at the moment of death, naturally. Paragraph 11, paragraph 12, 1 of the Inheritance Tax Act, the Erbschaftssteuergesetz, plus 12, 1 of the Bewertungsgesetz here. That's 103,618. By the way, this might not be trivial at the moment, or in a case when you inherit a foreign bank account where the currency is not the euro, but let's say dollars, pounds, rubles, or whatever you can imagine. So we have dealt with that. There is, I believe, and you believe it too, no specific tax exemption for bank accounts. Would rather be surprising. So let's look to the house in Düsseldorf. This is inherited, and so we have again to think about to be valued with the value at the moment of death. Paragraph 11 again, probably you can remember that again. And there we need to look which value will be applied. So just to be on the safe side, let's have a look into the tax act. Now let's look to 12.1 again. The valuation is made as far as nothing else is stated in paragraphs 2 to 7 according to the Bewertungsgesetz. Now we have to look to be sure if something else is stated. And indeed now you see paragraph 12.3, real estate property and houses, surprise, are real estate property, is to be valued according to the value found according to special rules in paragraph 151, sentence 1, number 1, Bewertungsgesetz, for the valuation date. Well, now we do not look deeper into 151. These are rules how to determine or how to estimate the market value of a house or piece of land on a given date. So that 12.3 now enables us also to take the market value. Okay, in former times that was a strongly different way how to determine the real estate property value. That has been skipped and changed after an intervention of the German Constitutional Court, the Bundesverfassungsgericht. And so nowadays what they had to introduce into the valuation law was a procedure how the market value can be relatively precisely estimated, and that is what allows us to take the market value. So to be valued at the moment of death with the real estate value, that's market value also, but they have determined how it has to be estimated if it's not clear. 12.3 Inheritance Tax Act here, that's 500,000 euro for the house in Düsseldorf. Now, there might be a faint remembrance somewhere in your brains that there was a specific valuation rule or specific exemption for certain houses which were in the EU or EEA. And so we should check paragraph 13, 13a, b, c, d, and so the tax exemption area of the Tax Act, if there is anything which could help us. Well, there was first something about 13.1 number 4, 4a, donations where one spouse transfers a house to somebody, to the other spouse. No, not our case. Inheritance by the surviving spouse or surviving life, not our case. 4c, inheriting a family home, not our case, because in the house in Düsseldorf the family doesn't live. So we just hop over to 13. Let's kill all the suspense to 13d. There we get a surprisal, because real estate property is, according to that rule, only to be valued with 90% of its value, but only such real estate property which is alluded to or defined to in 13d3, paragraph 3. So the reduced valuation applies for real estate property with buildings or parts of such a property which are let to tenants, are situated in the inland or in the EU or EEA, and do not belong to a business property, because then they would have already been included in the valuation of the business. Yeah, so 13d2 says an acquiring person cannot claim the reduced value as far as he or she has to transfer the real estate property to another person because of a clause in the last will of the deceased, and so on. The same applies if one heir transfers property to another heir in the course of distributing the inheritance. So only what you keep for yourself that can be valued at the reduced amount of 90%. Okay, but that seems to be the case here. Son inherits the house in Düsseldorf and is not obliged to hand it over to somebody else or to sell it or what else. So, well, perfect. Everything seems to be fine. We can make a note and then we have a result. However, the house is only taken into account with 90% of its value, here 450,000 euro, because of paragraph 13d1 in combination with 13d3, because house is real estate property, is let to tenants, situated in the EU, here inland, and is not part of a business property. So we have here a value of 450,000. Now we have the house in the foreign country, which served as family home for M and S, and which S is going to continue live in the future too. First question is probably, how will that house have to be valued? To be valued at the moment of M's death. That was paragraph 11. That was the arisal of the tax. With the market value. And now the question is it still 12.3 or is there something else? And just let's try to be on the safe side. So let's look into the Tax Act again. Now, as you see here, real estate property is to be valued with the procedure described in 151 of the valuation law, the Bewertungsgesetz. But if you go on looking through the rest, then you see in 12.7 real estate property abroad, outside the inland, and business property outside the inland are to be valued according to special rules. Paragraph 31 Bewertungsgesetz. So you have to look there, and let's try to have a look. Do we have 31? No, we do not have 31. That's deplorable, ladies and gentlemen, an evident lack of precision here in the Tax Act translations. What I already told you, it's never comprehensive. That's not possible. Well, then you have to take it from me. Paragraph 31 says just you have to value that house with common value. The difference is that the procedure of the valuation is a bit different. But the outcome and the aim is the same. We want to determine the market value, and in the inland here you can have more precise information or more precise rules which data shall be used for determination of the market value. Such, let's say, statistics and such things you do not really always exist in exactly comparable way abroad. So when you describe the procedure for valuing a house abroad, you must be a bit more flexible, and that explains that 31 rule in the Bewertungsgesetz. So it's not a difference in the outcome. The aim is in both cases the market price, but it's a difference in how the procedure works, how the market price shall be estimated. You must always imagine this concrete house has not just been sold at this day of death, so you don't have an actual market price. You have to estimate it, and then you need rules, and that's just the explanation for that difference. So that's 12.7 of the valuation law in combination with paragraph 31 of 12.7 naturally of the inheritance tax, the Erbschaftssteuergesetz in combination with 31 Bewertungsgesetz, and that leads us, according to the data in the case, to 600,000 euro. But, ladies and gentlemen, we have now again to take a look at potential tax exemptions. You remember there was something about family homes. And, well, let's have a look again and check if an exemption is possible here. As you perhaps remember, there was something in the 13.1 number 4 area, not 4, but 4a, donations between living persons where one spouse gives a house to another spouse, no. Acquisition of one house by a surviving spouse, no. 4c. Let's have a look on that. The acquisition on grounds of death of immovable property. Yes, a house is immovable property, and yes, we have an acquisition on grounds of death. Situated in the inland, the EU or the EEA, yes, and our case data says the M&S lived abroad, but in a country of the EEA, and there is the house. Okay, so condition fulfilled. By children mentioned in text clause 1, number 2, or children of deceased children, so either by children or by grandchildren where the intermediate child has already died. as far as the deceased used rooms therein to live there himself. Okay, so if you have a house where the family lived in, that means only the rooms which were for own usage of the deceased are tax-free. That was probably made to avoid an evident tax-saving model, that you build a house with 10 floors, rent out 9 floors to somebody else, and then live in the ground floor. Because then your family home effectively is only the ground floor, and so only the ground floor should be exempted. Otherwise, it would be a great way to save inheritance tax just to build enormous houses with 100 tenants and then to inhabit just one flat in that building before death comes. So that's a convincing restriction. And to exclude too high luxury, the exemption is also restricted to family homes which have no more than 200 square meter for living. The house is here called house. Nothing else has been mentioned. The most houses I know do not have more than 200 square meters. That is, by the way, also the explanation for the limit here. So most have 100 or 150 or so, but not more. So we can, if there is no additional information, usually assume the average, the usual case constellation. And so let's assume that the house doesn't have more than 200 square meters. In that case, you will get an exemption. Now have a look to sentence 5. The exemption is revoked with effect for the past, retroactively, if the acquirer within 10 years after the acquisition moves out, does no longer use the family home for his own living there, except in those cases where using the house is hindered by compelling reasons. Okay, so acquirer is, acquirer dies after 5 years. That hinders acquirer by compelling reasons to go on using that house for additional 5 years, or acquirer is run over by a bus and spends 2 years in hospital. That is a compelling reason. So what they want to avoid is that you claim the exemption for a family home, then after 2 years move out and sell the thing or use it for placing tenants inside. That's evidently what is meant. Okay, so but in our case it can be regarded as a family home. It has the right location, so it will be tax-free. Now you might possibly say, if it's a family home, why do I then need to determine the market value first? Well, look to sentence 5. If something goes wrong in the future, then the whole tax assessment will be changed, and then for that purpose you need to know the market value. And it would even be great if you know the market value, because then you could even determine how much tax you save. And naturally, if you know perhaps that you would have to pay an additional 150,000 or so, that's a difference. That makes a difference for your decision if you move out or not within the next 10 years. If you find out, okay, it would only cost you some 10,000, that's different. Okay, so let's take a note and write down that we have a tax exemption here. So, but that house is tax-free as a family home under paragraph 13(1) number 4c Erbschaftssteuergesetz, because it is inherited by a child of tax class 1 number 2. That was in paragraph 15(1) tax class 1 number 2 C below, let's say, is located in the area of the EU and will be kept during the next 10 years for living or housing purposes of the heir. Yeah, so that's it. So taxable value at the moment 0. Okay. Now let's hop over to the life insurance contract. The life insurance contract. Yeah, that's to be valued with the nominal value because it is a claim to capital or to money. C12.1 Erbschaftssteuergesetz in combination with paragraph 12.1 of the valuation law. Valuation law, which says plainly and simply take the nominal value, so 200,000. Now let's talk about deductions for liabilities. By the way, which letter do we have? We had C, this was D. Now we can think about deductions. Liabilities, inherited or deductible. There were no legacies mentioned. There were no credits taken over or inherited from M mentioned, but there is naturally always the funeral costs, 5.3, number 3, minus 10,300 euro without any proof. And there is no indication for higher funeral costs here, so we deduct this amount and can't deduct more. Now, what else? Personal allowances. We have first the general personal allowance, paragraph 16. For this, we need to determine the tax class. We have not yet done this, or we have done it, but we have not yet checked it, and that's serious. There is always a risk, so we are going to look that up for reasons of certainty. So paragraph 15, tax class 2, no, that's not what we need. Tax class 1, children and stepchildren are 15.1 number 2, so we remembered that correctly. So after having got this information, let's look for the general allowances in 16. 16.1 says, for children, as mentioned in tax class 1 number 2, a general free allowance of 400,000 can be deducted, and naturally we are going to do this. Because we have a case of unlimited tax liability, you remember one of the two persons involved being unlimited tax liable, that's sufficient. Yeah. And there was also then 17.2, and we will have to look on that later. The child is paragraph 15.1 tax class 1 number 2, so personal allowance 400,000, see paragraph 16.1 number 2 of the Inheritance Tax Act in Germany. Additional personal allowance for the financial needs for during the time of growing up in paragraph 17 has to be tested because it's still a child. Okay, 20 years old is not what you really regard as a child, but the obligation of parents to bring up their children includes to finance their professional education. to allow them to learn a first job. And so sometimes that ends only later. I believe under German civil law or family law, I'm not absolutely sure. There is always the rumor that the parents' obligation to finance their children ends approximately at the age of 27 or so, because then it's no longer professional education, but it's rather more of professional laziness. So let's look it up, what paragraph 17 says for some person who is 20 years old. Okay, here we have what we need. 17.1 was additional allowance for spouses who survive, and 17.2 is additional personal allowance for alimentation for children if somebody is aged more than 20 years. Then the allowance is 10,300. Now, when somebody is up to 20 years, well, if you say the son is 20 years, then he is usually 20 years plus 2 days or 20 years plus 2 months. So if you say somebody is 20, usually you will be a bit older than 20. So aged more than 20 years would mean that's number 5, not number 4. Up to 20 years ends on your 20th birthday, because then you are 20 and some minutes. So that is why number 5 will be applicable here, 10,300 free allowance. S is 20 years old, so 20 years plus some days at least. Otherwise he would be 19. So applicable is 17.2 number 5, free allowance for alimentation purposes. Minus 10,300 euro. Yeah, now for the adding it all, because we have now, I hope so, nothing forgotten. So we have the bank account 103,618. We have the house in Düsseldorf 450,000, 90% rule. Sorry. We have the house abroad, 0, family home. We have the life insurance, 200,000. Then we have funeral costs. Oh, let's draw a subtotal. Subtotal. That will be 650, 750, 3,618 minus funeral costs, minus 10,300, minus general allowance, 400,000, minus alimentation allowance, so we get a new subtotal of, let's take a calculator. And if I'm not mistaken, what comes out is 333,018. 18. Now that is to be rounded down to even 100 euro. Do you still remember where that could be found, ladies and gentlemen? Oh, that was somewhere in paragraph 10. We should go on the safe side and have a look again. Yeah, here, congratulations, we found it. The bold type letters, the taxable amount is to be rounded down to full 100 euro. That is 10.1, and it's sentence number 6. So we know where we got our proof, 10.1 sentence 6 of the Erbschaftssteuergesetz, of the Inheritance Tax Act. And so we can note that down, write it down, and then go on. Paragraph 10.1 sentence 6. So we end up with 333,000 euro tax base. Now let's look for the tax rate and tax. We need paragraph 19.1 of the Inheritance Tax Act for tax class 1. Well, let's have a look. So let's look to paragraph 19.1. Here it is. We have 333,000. That is in the bracket up to 600,000. So we have 15% in tax rate in tax class 1. 15% is our tax rate. That is our result. We are going to go back with that result to our. So it was 15% up to 600,000. So 15% on 333, that is 49,950. Now we must still make the 19.3 test. Is the increase of that tax in comparison to the tax at the last threshold so intolerably high that we should reduce the tax a bit? So for this you have to to have a look at 19.3 again. Okay, 19.3, the difference between the tax which results from paragraph 1, so the tax under the tariff, our 49,950, and that tax which would be payable at the last threshold will only be leveled as insofar as it can be paid out of half of the amount which exceeds the last threshold. Now we need to determine what was the tax at the last threshold. That would have been 11% on 300,000. So let's do the 19.3 calculation as a test. So tax at the last threshold, 11% on 300,000, that would be, oh my God, 33,000. 50% of the difference to the last threshold, that's 33,000 minus 300,000, that's 33,000 by 50%, that's 16,500. And now so we get at the maximum for the tax, that is 49,500. And yeah, as you see, there is a slight difference between the tariff tax and the tax which is the maximum tax under 19.3. So we can, the maximum tax under paragraph 19.3 is lower than the tax under the tariff. So the tax is only 94,500 euro. This is everything. at that point of time. There seems to be nothing else, especially we do not have any foreign taxes which would not now have to be credited. We do not have other specific problems, so case is closed. Our final tax is 49,500. Okay, thanks for dealing with that case. I hope you could get a good impression how one works on these cases. I hope the one or other among you really stopped the video, tried to develop an own solution, and then compared his or her solution with mine. And well, hope you could learn a bit from it, and see you soon for the next exercise case. Thanks for watching.